Empire Earnings. Build your financial empire.
You open your brokerage app to buy a simple S&P 500 index fund and instantly hit a wall. You are staring at two nearly identical options, an ETF and a mutual fund. If you're a beginner, this is exactly where the anxiety spikes. It feels like picking the wrong one is a structural, costly mistake right out of the gate. The confusion makes sense because they look entirely different on your screen. One fund flickers with live prices ticking up and down all day, while the other just sits there, showing a single static number. Both vehicles hold the exact same underlying stocks or bonds. The label describes the mechanical delivery system used to move those assets into your account. Once you realize that, you can stop agonizing over which one is better. Instead, your focus shifts to picking the specific tool that mechanically fits your account and your daily life. If you take all your capital and drop it into one single company's stock, you are taking on massive concentration risk. This animation shows a better approach, a basket fund. Think of it like a giant pizza. Instead of eating just one ingredient, you buy a tiny slice of hundreds of different ingredients all at once. By spreading your money across 100 to 500 companies, you drastically reduce your overall volatility. If one company in that basket crashes, the total shape of your portfolio stays stable. Compare that to holding a single stock. If that one company takes a 50% drop, your entire life savings takes a 50% drop. Both ETFs and mutual funds execute this exact same basket function perfectly. They hold the same stocks in the exact same proportions. Since the ingredients are identical, your decision has nothing to do with what you are buying. It rests entirely on how you want that pizza served and priced. ETFs trade directly on the public stock exchanges. They behave exactly like an individual share of Apple or Tesla. This chart represents the real-time pricing of an ETF. Throughout market hours, the price moves constantly based on live supply and demand. That live connection means immediate execution. You hit buy, the trade settles, and shares appear in your account in seconds. This setup lets you use advanced controls, like a limit order. You can tell your broker to automatically buy the ETF only if the price drops to a specific target. You can also set a stop-loss order, a defensive move to automatically sell your position and protect your capital from a sudden midday market crash. To actually utilize those tools, you have to actively engage with the market and monitor your portfolio throughout the day. ETFs trade absolute control and execution speed for a specific behavioral risk, the temptation to overtrade when the numbers start flashing red. Mutual funds take an entirely different route. They bypass the public stock exchange completely, which means you are never buying shares from another trader. Instead, you are buying directly from the fund company itself. Your broker acts purely as a middleman in a much slower transaction. This shows the mutual fund pricing model. Net asset value. The price is calculated exactly once per day after market close. You submit a flat dollar amount, say $1,000, and the system buys whatever fractional shares that covers. This creates a delayed settlement reality. If you place an order at 9 in the morning, you are flying blind. You won't know the actual execution price until the business day is completely over. Mutual funds intentionally strip away daily control and speed. In return, they provide clean, predictable dollar budgeting and force you to be patient. This split screen shows the reality of your brokerage app. On the left, the ETF interface gives you charts and flickering numbers. On the right, the mutual fund gives you a clean screen and a single daily balance. That ETF design inherently invites you to watch live prices, react to breaking financial news, and adopt a trader mentality. The mutual fund design does the exact opposite. By hiding the midday noise, it naturally encourages a set-and-forget savings mentality. Sometimes technological friction is a massive benefit. If you can't sell your shares instantly during a terrifying midday market dip, you are physically protected from your own panic. Choosing between an ETF and a mutual fund is ultimately a choice about the psychological environment you want to build for your future self. Now we apply these mechanics and mentalities to the real world to find out where your money actually belongs. The natural habitat for a mutual fund is an employer 401k or a traditional retirement plan. A mutual fund perfectly accommodates automated payroll deductions. It automatically slices off a flat dollar amount from every paycheck and invests it. Over a 30-year retirement, knowing the live S&P 500 price is pointless. Your money just steadily builds in the background. This maps perfectly to the set-and-forget investor profile. Someone who wants maximum psychological distance from the stress of the stock market. If hands-off automation and emotional distance are your top priorities, mutual funds are the optimal vehicle. Standard taxable brokerage accounts are an entirely different environment. ETFs dominate this space because they offer maximum flexibility, high tax efficiency, and move cash instantly. This brings us to the active controller. This investor uses ETFs to precisely time their entries and exits during volatile, heavy trading days. They utilize those advanced limit orders and live pricing to optimize their tax burdens and minimize fees in real time. But that freedom has a sharp edge. Absolute speed requires immense discipline to avoid making emotional, reactive mistakes with your capital. To make your choice, you only need to answer two questions. Where is this money going, and what is my investing style? There is no universal winner between these two funds. There is only the mechanical tool that perfectly aligns with your specific account constraints and protects you from your own worst habits. Imagine building a massive reservoir to store your water, only to realize years later that a tiny, invisible crack has been silently draining away your supply, drop by drop, every single day. That exact same slow leak happens in investing. We are constantly told that ETFs are a low-cost tool for building wealth, yet millions still funnel their paychecks into mutual funds because they are easier to automate. While the assets you buy drive your returns, the container you choose determines how much of that growth you actually keep. This chart shows what a small fee difference looks like over time. If you invest $10,000, a 0.5% annual fee difference looks minor in the early years. The two lines track right next to each other. But stretch that out over 20 and 30 years. That tiny 0.5% gap compounds, taking thousands of dollars off your final balance. That red area represents the money you lost to friction. To protect your growth, we have to look under the hood. We are going to compare these two vehicles head-to-head on how they price your trades and how they structure their fees. Deciding between an ETF and a mutual fund means figuring out what threatens your wealth more. Are you more likely to lose money to hidden mathematical fees or to your own panic-selling behavior? This document breaks down how ETFs trade. As you can see, ETFs show a live price during market hours, moving every single second. You get precise control, reacting instantly to lock in that exact price. But that control comes with a psychological tax. Watching numbers blink red and green creates a persistent feeling of urgency. It tempts people into trying to time the market, which usually ends with buying high and selling low. Mutual funds remove that temptation completely through a mechanism called net asset value, or NAV. Instead of updating every second, a mutual fund's price is calculated exactly once per day, only after the market closes. Look at the mutual fund section here. If you buy $1,000 of an S&P 500 fund today, it doesn't matter if you click at 9 a.m. or 3 p.m. Everyone trading gets the exact same closing price. You never see intraday swings. If the market drops 3% at lunchtime and recovers by the afternoon, you completely miss the roller coaster. Because the price is fixed at the end of the day, mutual funds allow you to easily automate your investing. You just pick a dollar amount, set a schedule, and let the system run in the background. ETF live pricing is built for optimization and live control. Mutual fund pricing, by contrast, acts as a psychological shield, protecting long-term investors from their own daily anxiety. Let's talk about what this convenience costs. Both vehicles charge an expense ratio, a small annual percentage taken out to cover the fund's management. Here's a breakdown of those fees. A modern, low-cost ETF is hyper-efficient. It might charge an expense ratio of just 0.03%.
And as you can see under Bullet 4, there are 0 loads and 0 commissions. The only real friction is the bid-ask spread, the tiny gap between the buy and sell price. It takes a little manual effort to place the trade, but for large, liquid ETFs, that spread costs practically nothing. A low-cost index mutual fund is slightly higher, usually hovering between 0.10 and 0.20%. For the ease of daily automation, that is a perfectly acceptable trade. But the mutual fund landscape is filled with traps. Many active funds carry severe hidden penalties that actively destroy your wealth. The most immediate danger is the front-end load. This diagram illustrates how destructive a 5% front-end load is. If you invest $10,000, $500 gets siphoned off immediately to pay a broker commission. Only $9,500 actually makes it into your investment account to start growing. This document also highlights back-end loads, which trap your money by charging a 3% penalty if you sell early. Then there is the ongoing drain, 12b1 fees. These automatically take another quarter. If you are an active allocator who demands the absolute lowest mathematical fees, prefers manual control over your trades, and can truly ignore the stress of intraday market dips, then ETFs are the definitive choice for your portfolio. The 0.03% efficiency is unbeatable as long as you don't panic sell. On the other hand, maybe you are a time-poor investor. You want to automate your monthly deposits, you value simplicity over perfect pricing, and watching the market drop midday ruins your focus. In that case, the end-of-day NAV pricing of a low-cost index mutual fund is well worth the slightly higher fee. It keeps you steady. But if you choose the mutual fund route, you have a crucial assignment. You must actively read the fund's prospectus, verifying it has 0 front-end loads, 0 back-end loads, and 0 12b1 fees. Clearing out those hidden penalties removes the friction from your investments, letting your capital compound unobstructed over time. Building wealth over the long term requires choosing the vehicle that allows you to stick to your strategy, automate your habits, and sleep peacefully through the turbulence. You decide to invest in the S&P 500, so you open up your brokerage account. But immediately you hit a fork in the road. You see a mutual fund version and an ETF version, and they look virtually identical. Both of these funds hold the exact same 500 companies in the exact same proportions. Because the ingredients match, it is easy to assume the packaging doesn't matter. You might think you can click either button and get the exact same financial result. But as this document explains under point 10, picking the wrong structure for your specific account type creates a hidden tax penalty. Over decades, leaving those extra gains to compound can mean thousands of dollars more in your pocket. The gap in performance has nothing to do with the stocks they hold. It comes entirely from the internal plumbing, how each fund actually operates behind the scenes. Specifically, this internal plumbing controls 2 major points of friction: how efficiently the fund shields you from annual taxes, and how much cash you need to open your account. Learning how these 2 mechanisms work is the only way to avoid unnecessary tax drag and let your money compound. Let's look at the traditional mutual fund first. When a mutual fund needs to create or redeem shares, it operates on a cash system. If a large group of investors gets spooked by the market and decides to cash out, the mutual fund has to pay them. To get that cash, the fund is forced to sell off pieces of its underlying stock portfolio. If the fund sells those stocks at a profit, it generates a capital gain. By law, that taxable gain is passed directly to you, the remaining shareholder who decided to stay invested. Looking at the IRS rules in points 5 and 6 here, we see the harsh reality of this system. You receive a 1099 form and owe tax money to the government, even if you never sold a single share of your mutual fund. ETFs were designed to bypass this specific problem using a modernized system called in-kind creation and redemption. Instead of dealing in cash, an ETF skips the selling process. It handles redemptions by directly swapping baskets of stocks with authorized institutional banks. Because no stocks are technically sold for cash inside the fund, almost 0 internal sales occur. That translates to 0 capital gains passed down to you. Point 7 in our documentation confirms the result. Because of this in-kind mechanism, fewer taxable events happen. ETFs are simply more tax efficient in standard brokerage accounts. The ETF structure isolates you from the actions of other investors. If you are using a standard taxable brokerage account, the underlying math is clear. ETFs protect your gains. Now, if your primary investment vehicle is a 401k or an IRA provided by your employer, your situation is completely different. That mutual fund tax penalty we just broke down does not automatically mean your retirement account is bleeding money.
Tax-advantaged accounts operate like a protective shell around your money. They neutralize the internal tax inefficiencies of whatever fund you hold inside them. As shown here in Section 8, because you do not pay tax every year inside an IRA or 401k, the extra tax drag from those internal mutual fund sales doesn't actually hurt your yearly compounding. This is why many employer-sponsored plans exclusively offer mutual funds on their menus. Inside that specific environment, they work perfectly well. When your money is protected behind a retirement shield, the distinct tax advantage of an ETF disappears. The mutual fund becomes a completely safe default option. Taxes are only half the plumbing equation. The second major hurdle is the physical cash required to just get in the door. Outside of sheltered retirement plans, traditional mutual funds act as gatekeepers. They demand significant upfront capital before letting you open an account. According to the data in points 5 and 6, mutual funds routinely ask for $1,000 to $3,000 just to start. If you only have $200 saved up from your paycheck, you are blocked out of that fund. ETFs strip away this gatekeeping entirely because they trade on an exchange, operating on a per-share basis. If an ETF is trading at $480, you don't need a $3,000 minimum. You just need enough cash to buy one single share at the current market price. And it goes further. Many brokers now support fractional shares, meaning you can invest $48 and own a tenth of that ETF, dropping the barrier to entry to essentially zero. Getting a small amount of money into the market today is mathematically far more powerful than waiting a year to save up a massive lump sum. ETFs democratize the process, letting tight budgets compounding immediately. Strict mutual fund minimums delay entry and cost beginners their most valuable asset, time. Choosing between these two isn't a matter of guessing. The right choice depends on how you answer two specific questions about your current financial setup. The first decision node is location. Where is this money going? Are you opening a standard taxable brokerage or contributing to a 401k or IRA? If you are the retirement investor taking the IRA route, mutual funds are perfectly fine. The high account minimums are generally waived inside employer plans, and the account itself acts as a shield against any internal tax drag. If you are opening a normal taxable brokerage, we hit the second node. How much money are you starting with? If you are a beginner working with a budget under $1,000, choose ETFs. By utilizing single and fractional shares, you bypass the mutual fund gatekeepers and get your money compounding today. And if you have over $1,000 and want to optimize that taxable account, you should also exclusively use ETFs. That in-kind plumbing eliminates annual tax track and protects your total wealth. The label on the fund matters because the internal mechanism dictates how it behaves. Match your account type and your budget to the correct internal structure, and the math will work in your favor.
You want to invest for the long term, but starting usually means wading through a maze of conflicting advice. Every corner of the internet offers a different opinion on exactly which letters you need to buy. Beginners often fall into a trap based on a false assumption. The idea that ETFs are automatically passive and safe, while mutual funds are inherently active and expensive. That assumption confuses the container you buy with the strategy operating inside it. The financial industry has blurred the lines between the investment wrapper and the investment engine. Buying an ETF simply because it has the right label can still stick you with massive management fees or pull you into a stressful daily trading loop you never signed up for. Picking a popular acronym guarantees nothing. Building a portfolio that actually functions requires separating the vehicle from the engine. We can clear this up by mapping your options onto a simple grid. We have two independent choices. On the bottom axis, your wrapper, ETF versus mutual fund. On the side axis, your strategy, active versus passive. A passive strategy puts a computer algorithm in charge. It strictly copies an index, buying what's on the list without a human manager trying to guess the next big winner. Put that passive strategy inside an ETF wrapper and you get something like VOO, an ETF that strictly copies the S&P 500. You can put that exact same passive strategy into a mutual fund wrapper. VTSAX does the identical job of tracking an index algorithm entirely by computer. An active strategy requires a human manager who constantly rotates stocks, intentionally trying to beat the market average. Put that active human manager in an ETF and you get funds like ARK. It trades throughout the day, driven by active stock picking. Put that same manager in a mutual fund and you get traditional products like the Fidelity Contra Fund. Looking at the definitions in our source material,
Items 2 through 5 explicitly map out these examples. The strategy operates independently of the fund type. ETFs and mutual funds are merely delivery boxes. The outcome of your investment depends on the active or passive engine you place inside them. Choosing between an active or passive strategy is a question of overhead costs and statistical probabilities. Our research excerpt highlights the math. Under Item 6, we see passive funds run extremely lean. With no expensive managers, fees sit near zero, typically around 0.03 to 0.07% a year. Scroll down to Item 7 and the active contrast is sharp. Paying for research teams and executive salaries pushes your annual fees up to 0.5% or even 1.5%. Over a 30-year timeline, that 1.5% fee acts like a drag coefficient, continually siphoning off the compounding growth of your money. With the active route, you pay a premium for the attempt to beat the index. Statistically, after subtracting high fees, most active funds earn less than the market average over time.
With a passive fund, you accept the market average. In exchange, you guarantee that you keep nearly all of your returns. For most investors, low-cost passive tracking wins. You stop bleeding fees, and you avoid the difficulty of successfully guessing which manager will beat Wall Street. Once you lock in a passive strategy, choosing between an ETF and a mutual fund comes down to how you want to automate the execution. The mutual fund path is built for automation. Set a $300 transfer every month and money flows right in. Operating on a net asset value, the fund's price locks exactly once at the end of the trading day. You never see intraday price swings. There are no live trading screens and zero anxiety about buying at the wrong hour of the day. The ETF path operates differently. While designed for manual trading, many brokers now allow the same automatic recurring deposits, but ETFs trade live. When your deposit hits, the broker executes the purchase at the exact market price that second. Item 8 in the research text shows the volatility of this method. Your execution price bounces based on the day. $420 one month, $430 the next, then down to $410. Despite those swings, the mechanics still work through dollar-cost averaging. Consistent buying ensures you capture the average price over time. The ETF gives you the flexibility to mix automatic deposits with manual trades. The trade-off is accepting live price volatility and minor spread costs during execution. The choice between an ETF and a mutual fund settles on a single factor: the psychological friction of the purchase mechanics. To find the right vehicle for your personality, we can map your financial mechanics directly to your behavior. This decision tree starts with the primary strategic filter. Do you want to match the market or try to beat it? We eliminate the beat market branch immediately. High fees make active management a losing proposition for the vast majority of people. Sticking to the match market path, your final filter is a behavioral question. Do you want to see live asset prices? If you hate checking the market, value absolute consistency, and want zero stress regarding purchase timing, then you are a set-and-forget earner. The passive mutual fund is your vehicle, optimizing for psychological smoothness. If you demand total control, occasionally want to execute manual trades, and can tolerate live price fluctuations, you are a DIY optimizer. The passive ETF trades that smooth simplicity for ultimate flexibility. Aligning the investment wrapper with your personality limits friction. It helps you stay invested during market turbulence and prevents panic selling. Strategy dictates your financial returns. Wrappers only dictate your user experience. As long as you choose a low-cost tracking engine and stick with it, time itself will eventually do the heavy lifting. A successful investment plan is simply the one you can automate and comfortably ignore for decades. Building wealth is a relatively straightforward goal, but the financial industry buries it under a mountain of specialized products. You start looking for a simple place to put your savings, and suddenly you're trapped in a maze of ticker symbols and fund types. Take one of the most common decisions, choosing between an exchange-traded fund, or ETF, and its mutual fund twin. You might look at an ETF like VO and a mutual fund like VFIAX. They both track the exact same S&P 500 index. They hold the exact same stocks. These vehicles hold identical assets, so their return lines match perfectly. But look at these question marks. Their internal structures carry completely different tax consequences and behavioral triggers. The wrong choice creates a quiet drag on wealth, losing points to unnecessary taxes or emotional trading. The right answer doesn't depend on what the fund actually holds.
It depends entirely on two factors outside the fund: the specific type of account you are using and your own psychological temperament. So step away from analyzing the underlying stocks. To make this choice, you need to look at how your brain reacts to market stress and whether you are investing pre-tax or post-tax money. Let's look at a standard taxable U.S. brokerage account. This is money you've already paid income tax on. In this environment, every internal sale a fund manager makes to rebalance their portfolio can trigger a taxable event. Traditional mutual funds pass those internal capital gains directly down to you. Even if you didn't sell a single share yourself, you can get hit with an annual tax bill just for holding the fund. This diagram illustrates how ETFs bypass that problem using a mechanism called in-kind creation and redemption. While the mutual fund pipeline on the left ejects its internal trades as taxable events onto the investor, the ETF pipeline loops those exchanges internally. Because the ETF swaps large blocks of shares with institutional broker-dealers instead of selling them for cash, very few actual sales occur inside the fund. That internal loop severely limits and sometimes completely eliminates capital gains distributions. For you, holding this in a taxable account translates to a mathematically smaller tax burden year after year. You keep more of your own money working in the market. The main trade-off for that efficiency is execution. To get those tax benefits, you have to log into your brokerage app during market hours and manually place the buy orders yourself. If you are putting post-tax dollars into a standard brokerage account, ETFs provide a defensive shield that protects your wealth from unnecessary tax erosion. Because ETFs trade exactly like regular stocks, their prices fluctuate second by second throughout the trading day. You see exactly what they are worth in real time. That live pricing gives you tactical control. If the market suddenly drops at noon, you can step in and buy shares at that exact lower price. You can use limit orders to specify the absolute maximum price you are willing to pay, ensuring you never overpay during a volatile swing. You can also set stop losses, instructing your brokerage to automatically sell your position if the price drops to a certain level, protecting you from severe intraday crashes. They are highly accessible to start. Many platforms let you buy fractional shares. If you only have $50 to invest on payday, you can buy a tenth of a share and start building immediately. Experienced investors use this flexibility to build highly customized portfolios, mixing different sectors, countries, and bond allocations all within a single account. But having absolute live action control over your portfolio carries a massive hidden behavioral cost. When you see the numbers flashing red and green all day, it triggers the psychological urge to time the market. You hold off on investing your cash because you are waiting for that perfect entry point. Watching a live ticker generates anxiety. Instead of committing to a long-term hold, investors let daily news cycles and midday price swings push them into emotional trading mistakes. Intraday control offers brilliant precision if you are a seasoned active trader. But for the average long-term saver, that live pricing is a psychological trap that encourages bad habits. This brings us to the workplace, specifically retirement accounts like 401ks and 403bs. When you log into these plans, you will notice ETFs are usually absent. You are restricted entirely to a menu of mutual funds. This graph compares the two pricing models. While the ETF traces a jagged, volatile path all day, the mutual fund is represented by a single dot at the end. Mutual funds price once per day after the market closes, at their net asset value, or NAV. That single daily price shields you from bid-ask spreads and the anxiety of midday market crashes. You never see the live price, which removes the emotional stress of watching it fall. The absolute mechanical advantage of a mutual fund is automation. Because they operate outside of live market hours, you can set up seamless, automatic payroll deductions. You dictate that 10 to 15% of your salary goes directly into the fund every time you get paid. The system buys at that day's NAV, completely removing the burden of having to remember to invest manually. This builds a strictly hands-off mindset. You ignore the daily news cycle, you ignore the ticker, and you let the system do the work while you focus on decades of growth. By entirely removing the human element from the execution process, mutual funds act as the superior vehicle for automating disciplined, emotion-free wealth building. These investment vehicles are simply tools, and like any tool, their effectiveness depends entirely on the job site. This flowchart provides a definitive decision framework. The process starts by answering one primary question: where are you investing? Let's map out the first path. If your money is going into a tax-advantaged workplace retirement plan, like a 401k or an IRA, this environment demands the priority of automated set-it-and-forget-it contributions that shield you from emotional trading. The final outcome for this path is the low-cost index mutual fund. Now, the second path, if your money is going into a standard post-tax brokerage account. This path penalizes internal fund sales, so it demands absolute tax efficiency and hands-on control of your entry prices. The final outcome for the taxable path is the exchange-traded fund. Regardless of the path you take, there is a universal rule: avoid expensive, actively managed funds. You want broad index exposure, like the S&P 500, with fees strictly under 0.10%. You do not need to stress over the exact ticker symbols. Match the structural vehicle to the account type, automate the process wherever possible, and let time do.
It's incredibly tempting to pick a fund because it has a name like Future Growth Titan, or because it tracks a trendy tech sector you saw in the news. But when you sit down to allocate your capital, the avalanche of data triggers decision paralysis. You face a wall of acronyms and have to choose between ETFs and mutual funds. That confusion routinely causes people to either delay investing entirely or default to chasing speculative trends. Neither an ETF nor a mutual fund is a magic vehicle that guarantees higher returns. Instead, the structural differences between these two wrappers determine how much of your profit stays in your pocket versus leaking out to fund managers and the IRS. We are going to ignore the hype of hot sectors. Instead, we'll use a simple, rules-based framework to match the right investment vehicle to your specific account types and behaviors. To understand the stakes of this decision, we must look at the math of a low-cost index approach compared to an expensive, actively managed fund. Look at this chart tracking two identical $100,000 investments over a 30-year timeline. Line A carries a low 0.2% expense ratio. Line B carries a 1% expense ratio, plus a 1% front-end load that takes a cut before the money even starts working. By year 30, look at the massive deficit between these two portfolios. Line B didn't suffer from worse market performance. That gap represents hundreds of thousands of dollars lost entirely to the friction of fees, draining capital before it can compound. Long-term investing success rarely comes down to picking a winning stock. It comes down to minimizing the structural friction of fees and taxes from day one. The first evaluation factor in our protocol is tax efficiency, and that depends entirely on where you place the asset. Consider what happens when you place an actively traded mutual fund into a standard taxable brokerage account. The fund manager is constantly buying and selling stocks internally. By law, those transactions generate annual capital gains, and those gains are passed directly on to you. You receive a surprise tax bill year after year on money you haven't even withdrawn. You have to pay taxes on those internal gains, creating a severe, recurring drag on your compound interest. This schematic contrasts that process with an ETF in the exact same taxable account. The ETF structure legally shields its internal trades from those tax leaks, while the mutual fund structure drops those obligations right into your lap. The ETF gives you highly tax-efficient index exposure that minimizes your annual tax bills. The trade-off is that you generally have to log in and manually purchase the shares yourself. This gives us our first rule. For taxable accounts, minimizing annual tax drag is your primary survival metric. That makes the ETF the mathematically superior default choice. We have to balance the math with the psychology of investing. You are trading off between automated discipline and the desire for intraday control. Think about the mechanics of setting up a mutual fund inside an employer-sponsored 401k or an IRA. This diagram shows the flow of money in that structure. You get exact automated payroll deductions. A set percentage of your salary bypasses the daily volatility of the market and drops straight into your fund, regardless of the current share price. You lose the ability to trade intraday at live prices. In exchange, you gain the massive psychological advantage of set-and-forget investing. You don't have to think about it every month. Contrast that with ETFs. Because they trade like individual stocks, investors frequently fall into the trap of logging in to buy, getting spooked by a 2 or 3% market dip, and hitting sell. That behavior leads to high portfolio turnover.
You end up realizing short-term losses driven entirely by emotion. You gain total control over your execution timing with an ETF, but you severely risk underperforming the long-term upward trajectory of the index because you panic at the wrong moment. Automation protects you from your own emotional impulses. If you struggle with the discipline of market timing, mutual funds are your ideal vehicle. The final evaluation factor is portfolio complexity. Many investors believe that buying more funds automatically equals more diversification. You might buy 15 different growth or tech mutual funds, assuming that spreading your money around provides a safety net. Watch these 15 funds converge in this diagram, revealing massive overlap. Beneath the different names, you actually own the exact same core tech stocks. You achieve the illusion of diversification, but pay 15 times the management fees for essentially one concentrated position. The alternative is selecting a simple portfolio composed of 2 or 3 broad index funds. Those broad funds capture the growth of the entire market, and they do it without stacking overlapping fees on top of your capital. Portfolio complexity usually only benefits the managers collecting the fees. A simple, low-cost portfolio objectively beats a confused, high-fee portfolio over a 30-year timeline. We can map these rules into a decision tree. It starts with, what account are you using? For a taxable brokerage account, prioritize ETFs to minimize tax drag. For a 401k or IRA, utilize mutual funds to automate deductions and tune out market noise. Regardless of which vehicle you land on, there is one universal filter you must apply. Check the expense ratio. Aim for 0.2% or less, and strictly reject any fund that hits you with high fees or front-end loans. Maintain your discipline. Keep your total portfolio to a simple 2 or 3 broad index funds, rather than chasing a dozen different themes. Building long-term wealth depends on selecting the tool that aligns with your specific account type, minimizes cost friction, and protects you from emotional impulses.